The Reserve Bank of Australia expects the economy to shrink by about 0.5% in relation to the recent drought and bushfires. We might expect the unemployment rate to rise somewhat given this outlook, as can be shown in the light blue line in this chart. Coronavirus has been an additional unwelcome event. The main risk here to our economy is not so much the virus itself, but that China is closed for business as they take measures to reduce the potential spread. The flow-on effects are being seen in tourism and the seafood export industries, where job losses are evident and export markets are basically shut. Some good news here around domestic house prices, which are now firmly on the rebound. There was some initial caution among lenders after the Royal Commission, but borrowers are back and are now finding it easier to secure home loans, which can be shown by the red line in this chart on the right. This flow of funds from borrowers is a key driver to the house price outlook, as is the level of interest rates, which don't look to be rising anytime soon. When the Reserve Bank sets interest rates, they are basically looking at two measures. One is the unemployment rate, the other inflation. This chart shows the light blue line, which is the unemployment rate, and is sitting at around 5% and firmly above the RBA's target of 4.5%. So on this measure, the RBA would say that interest rates need to be lower to support employment. Inflation is shown by the orange line, which is running at below 2% and firmly under the RBA's target of 2.5%. On this measure, the RBA would also say that interest rates need to be lower to support inflation. So on both measures, the RBA has little choice but to keep rates at these very low levels until we see either inflation or employment fire up. The portfolio implications are that low interest rates will underpin higher valuations in both stocks and property. And that's something we can talk about in a future video update.